I was just thinking the setup so far has your thesis is kind of worked nicely. Would you make adjustments to it if we do see growth really roll over?
Our thesis all year is that we've been cautiously watching the market. There's no doubt the market has had a great run the first 8 months of the year. Even with some volatility and a down month in August, we're still up. The S&P 19%, global equities up 15%. But there are a lot of headwinds, as Sarah and you were just mentioning. Inflation might be stickier than expected. We expect the Fed is going to have to keep rates higher for longer. We heard Susan Collins this morning say that until there is a clear path to inflation coming down, that the Fed will not revert and pivot. And that's what we think at NB Private Wealth. And all of that is going to lead to an economic slowdown that we think will eventually play out in lower corporate earnings and will have to affect equities. So you have to remember at NB Private Wealth, our job first and foremost is protection of our clients' irreplaceable wealth. So we have to grow their assets responsibly without taking too much risk and in a tax-efficient manner. And that's what we've done quite nicely. My team's AUM is up 15% year over year. The firm's AUM is up. And we protected nicely down year. We're growing this year. And we're going to stay the course and keep watching the headlines in the news.
Do you think there have been some calls this week from JP Morgan's a good example, who argue that the rate environment, even if it's just higher for longer, increases the risk of a crisis over the next 6 to 12 months? Is that sort of somewhere in your playbook?
It could be a soft landing. It could be a recession. We're not expecting a deep recession, or which is what I think you're referring to as a crisis. But we are expecting an economic slowdown. We do believe in higher for longer. And the market today is priced to perfection. We're expecting double-digit earnings growth next year. Multiples are trading above long-term averages. And so even if we navigate a soft landing, which has proven quite impossible in a tightening environment historically, we are going to see expectations pull back.
But S&P is up 16% this year. NASDAQ's up 33% this year. Do you worry that you missed the rally with some of these concerns?
We haven't missed anything. We have equity exposure. We haven't been overweight equities, and we will never position our client portfolios to be concentrated in the Magnificent Seven or FAMG or FANG. We will always have diversification in our equity exposure. So we haven't missed the rally, but the equity market is not appealing right now to go into more heavily. So we're finding really great returns in fixed income and opportunities for outside returns and alternatives in private equity and in private debt. And there are some warning signs. I mean, you look at oil. The price of oil is up 10% just this quarter. And Russia has said, Saudi Arabia has said that they're going to continue with their production cuts through the end of the year. That's a risk to a second wave of inflation. We're seeing wage inflation super high, is evidenced by all the union strikes that we're reading about. So there's a lot in China. What about China? Responsible for 40% of global GDP growth over the last 10 years. And their GDP number most recently is less than 4% annualized. That's really concerning to us. So we want to be mindful of all of the news. It's less fun to focus on the negative news, more fun to focus on the positive. And a client, actually, I think Sarah told you this, texted me last time I was on and said, there was some woman who looked strangely like you posing as the Grim Reaper of the financial markets. Not negative, but cautious and aware, I would say.
And we always ask, what would make you change the allocation and get more enthusiastic about stocks?
I would say if the Fed pivots, which we don't expect sooner rather than later.
To cuts, you mean?
Yeah, if they pivot to cuts, then it would be more, then we'd see a market, maybe a market pullback, and we'd go overweight into equities because bond yields would start to come down. But for now, we're going to stay the course, enjoy our growth and less volatility. There's a lot of unanswered questions.
You see at the bottom of the screen, looking for low-cost companies. Where would you say the richest minds are for companies that have made good progress with OPEX?
We are real believers in any industry you can find value companies. So we believe in active management and in doing due diligence on every company balance sheet. We're not going to buy just a sector to buy it. We're going to do fundamental research on